Hello viewers, welcome to my channel. I am Hasham Ali Khan. Last video I have completed 3 problems on dividend, calculating the market price per share according to Walter's model and Gordon's model. Now I am continuing the problems on that raising of capital chapter and problems on dividend policies. So here in this video I am going to cover up nearly 4 or 5 problems. So watch the problems till the end, don't skip in between. And before that, watch the theory videos. Until and unless you are conceptually clear, don't come to the problems. Simply understanding the formula and substituting the values, getting the answer is not the complete knowledge. If you want the complete command, be thorough on the concepts. So go to the playlist of my channel, select the subject, financial decision making, select the videos, raising of capital, select these videos, financial markets, dividend policies, and then only come to the problems. Now before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So always keep ready the problem, take the screenshot of the solution of few problems, then I'll explain all the points. See the problem number 4. I'm reading out problem number 4. Calculate the price of a share of X Limited under Walter's model and Gordon's model. So we have to calculate the value, market price per share of X Limited under both the models, Walter as well as Gordon. Earnings per share E is equal to 20. So I'm writing out E. E stands for earnings per share, 20 rupees. Dividend per share D is equal to 8 rupees, and cost of capital KE 10%. 10% means 0.10. Then internal rate of return R is 15%, 0.15, and retention ratio 50%. Retention ratio, the symbol is B. B is the symbol for retention ratio. So 50%, 0.5. This is the complete information given in the problem, and you are required to calculate the market price per share according to Walter and Gordon. So first I am applying Walter's model. According to Walter, the market price per share is calculated by the formula P is equal to D plus R by KE into E minus D divided by KE. This is the formula already we have applied in the previous problems. Now all the values are given here. Simply you substitute the values. In place of D, I am writing 8. In place of R, write down 0.15. KE 0.10. E earnings 20 rupees. Dividend 8. 20 minus 8. Divide by KE 0.10. Now reverse calculation you make. 20 minus 8 into 0.15 divided by 0.1 plus 8 divided by 0.1. You will get 260. Like this, in one stroke itself you can get the answer. No need to make number of steps. Reverse back calculation 260. So 260 is the market price per share of X Limited when we apply Walter's model. Now we'll apply Gordon's model. According to Gordon, the market price per share is P is equal to E minus E into 1 minus B. E into 1 minus B divided by KE minus BR. This is the formula. Now E stands for earnings per share, 20 rupees, already we are given. 1 minus B, B is the retention ratio, here retention ratio 0.5, divided by KE, KE is 0.10, minus B into R, B 0.5, R is 0.15. Now 1 minus 0.5 is 0.5, 0.5 into 20 is 10. 0.10 as it is, 0.5 into 0.15, you will get 0.075. So 10 divided by 0.1 minus 0.075, 0.025. Now divided, you will get 400 rupees. So according to Walter's formula, the market price per share is 260. According to Gordon's formula, the market price per share is 400. That's it. This is the end of problem number 4. Now next problem. Problem number 5. P Limited belongs to a risk class having a cost of capital 10%, KE. So here we are given KE is equal to 10%, cost of capital 0.10. It has 5,000 shares outstanding, selling at rupees 100 each. Each share face value is 100. So we assume the present market price is 100. So PO is equal to current price per share 100 rupees. The company is planning to declare a dividend of rupees 40 per share at the end of the current year. D1. D1 is the symbol which is used to denote the dividend per share at the end of the year. So D1 is given 40 rupees. What will be the market price per share if the dividend is declared and if dividend is not declared, assuming the hypothesis? First time we are going to apply Modigliani and Miller hypothesis, and this Modigliani and Miller support the irrelevance theory. That means the dividend policy and the market price per share are not at all related. That is So in this problem we have to find out what is the market price per share at the end of the year if dividend is declared and if dividend is not declared. Now hypothesis, case 1, if when dividend is declared, dividend how much? 40 rupees at the end of the year. If dividend is declared, what would be the market price at the end of the year? The formula is PO is equal to D1 plus P1 divided by 1 plus KE. This is the formula which is used to find out the market price at the end of the year according to PO stands for current market price. So current market price is 100. So in place of PO 100. D1 dividend at the end of the year 40 rupees. So in place of D1 40 rupees. P1 price of share at the end of the year, we have to find out. The unknown variable is P1. This we have to find out. 1 plus KE. KE is given 0.10. Now 100 is equal to 40 plus P1 divided by 1 plus 0.1 is 1.1. Now we make cross multiplication. So 40 plus P1 into 1 is 40 plus P1 is equal to 100 into 1.1 is 110. Now P1 is equal to 110. Bring this to RHS. 40 is on LHS. Bring it to RHS minus 40. So 70. The market price per share at the end of the year would be 70 rupees when dividend is declared. First case. Now case 2. When dividend is not declared, that is D1 is equal to 0. In the problem it is asking you to calculate what is the market price if dividend is declared and if dividend is not declared. Now here if dividend is not declared, D1 is equal to 0. So PO is equal to D1 plus P1 divided by 1 plus K. PO current market price 100. D1 0. No dividend. P1 we have to find out. Divided by 1 plus K, 1 plus 0.1. So 100 is equal to P1 divided by 1.10. Now if you make a cross multiplication, P1 is equal to 100 into 1.1, 110. So 110 is the market price per share if dividend is not declared. Dividend is not declared. So we have calculated 70 is the price when dividend is declared and 110 is the price when dividend is not declared. That means the wealth of the shareholder will remain same whether dividend paid or not paid. How it is same? See here, when dividend is paid at the end of the year, the shareholder is getting 40 rupees dividend and the market price per share he is getting 70 rupees. Suppose if he is selling the share at the end of the year. Suppose the investor was selling the share at the end of the year. So first of all he is getting 40 rupees dividend and share price is getting 70 rupees. So 70 plus 40, 110. Similarly, if the company has not paid the dividend, then he can get the market price per share 110. That means whether he get the dividend or whether he do not get the dividend, the value is rupees same 110. 110 rupees here and 70 plus 40, 110. That's all. This is problem number 5. Now, see the problem number 6. The firm is expecting dividend of 15 rupees per share at the end of the current year, D1. So here, D1 is equal to 15. And price per share at present is 100. Current market price, 100 rupees, PO. Price per share at the end, at current year. And capitalization rate of return is 12%. Cost of capital, K, 12%, 0.12. Evaluate the market price per share under approach, just like the previous problem. Modigliani and Miller approach. Dividends are declared and dividends are not declared. Exactly same, similar problem what we have done just now. Approach. So case 1, when dividend is declared, how much is the dividend? 15 rupees. So in place of D1 we'll take 15. So according to approach, PO is equal to D1 plus P1 divided by 1 plus KE. This is the formula. PO, current market price is 100. So in place of PO, we'll write 100. D1 is 15 plus P1 divided by 1 plus KE. KE is 0.12. KE is 0.12. So 100 is equal to 15 plus P1 divided by 1.12. Now if we make a cross multiplication, 15 plus P1 is equal to 112. P1 is equal to 112 minus 15, 97. So 97 is the market price per share at the end of the year if dividend is paid. That's it. Second, when dividend is not declared, if the company does not pay the dividend, then D1 is equal to 0. In that case, substituting the formula, PO is equal to D1 plus P1 divided by 1 plus K. PO is 100. D1 is 0. P1 we have to find out. 1 plus K, 1 plus 0.12. Now 100 is equal to P1 divided by 1.12. So now we make a cross multiplication. P1 is equal to 100 into 1.12. You will get 112. So 112 is the market price per share if the dividend is not declared. That's it. This is the end of problem number 6. 7th, 8th, 9th, 10th. These problems we'll do it in the next video. First, you see the 11th problem. Carefully see the 11th problem. Assuming that cost of equity is 11%. Cost of equity means 0.11. See here, after 6th problem, I am jumping to 11th problem because similar problem where we are going to finish it off. The in-between problems, that is 7, 8, 9, 10. These 4 problems we'll do it in the next video. So assuming cost of equity is 11% and rate of return on investment 12%. Then an earnings per share E is equal to 15. Calculate price per share by Gordon's model if dividend payout ratio is 10% and 30%. In this problem, it is asking you to apply Gordon's model. And already we know Gordon's model. According to Gordon's model, the market price per share is P is equal to E into 1 minus B divided by KE minus BR. Right? Now, 2 cases are there. The first case is when dividend payment ratio is 10%. That's what it is given in the problem. Dividend payment ratio is 10%. But for Gordon's model, we don't require DP ratio. We want retention ratio. So here, case 1, if DP ratio is 10%, it is given in the problem. DP ratio 10% means 90% is the retention. 10% company is paying the dividend, 90% company is retaining. The retention ratio B is equal to 90%, 0.9. Now we substitute P is equal to E. E is how much? 15. 1 minus B, 1 minus 0.9 divided by KE. KE is 11%, 0.11. 11%, or you can write down 0.11. Here 0.12. So KE is 0.11 minus B into R. 0.9 into R. R is 0.12. So 1 minus 0.9 is 0.1. 0.1 into 15, 1.5. 0.11. 0.9 into 0.12, you will get 0.108. Now subtract 1.5 divided by 0.11 minus 0.108, you'll get 0.002. So 750 is the market price per share. This 750 is the market price per share when the DP ratio is 10% or retention ratio is 90%. Now I am coming to the second case. In the problem it is given the DP ratio is 30%. When DP ratio is 30%, the retention ratio is 70%. 0.7. 30% paying, 70% retaining. So 0.7. Now substitute P is equal to E. E is 15. 1 minus B. B is 0.7. Divide by KE. KE is 0.11. Minus BR. 0.7 into 0.12. So 1 minus 0.7 into 15, you'll get 4.5. 0.11. 0.7 into 0.12, you'll get 0.084. Subtract 0.11 minus 0.084, 0.026. So 4.5 divided by 0.026, you'll get 173.08. So the market price per share at the end of the year is 173.08. This will happen if the DP ratio is 30% or retention ratio is 70%. So we have completed 4th, 5th, 6th and 11th. 4 problems I have completed in this video. Inshallah, we will continue the next problem in the next video.